Hello, and welcome to the Exponential Growth Podcast, powered by Angeles Investors. I'm your host, David Olivencia, co-founder of Angeles Investors, and a passionate advocate for leveraging innovation and technology to drive success. Let's get started. This is Exponential Growth. I also want to give gratitude to Salvi Media. They're the founding sponsor of the podcast. They're a premier executive content agency dedicated to crafting exceptional content and strategies that elevate companies' brands and their executives. They're creators of the Emmy Award-winning CEO series. I think many of you have seen that. We've also featured one of my portfolio companies, Angeles Investors and Hallow, on their CEO series. And they've had in-depth interviews with CEOs talking about their personal journeys and business experience. The CEO series can be found on Cheddar, Entrepreneur Magazine, Reach TV, and really want to thank Salvi Media for their support of the podcast. You can also follow them on social media, as well as they have a podcast studio in Chicago. Join them as well. So again, thank you, Salvi Media, for making this podcast possible. Today, we have a very, very special guest, somebody I've known probably 7-ish years or so from time in Chicago, both in the kind of investing circles, a bit of the Latino circles, venture circles. It's an honor and a joy to welcome the GP and founder of Chingona Ventures, Samara Mejía, to the podcast. Welcome, Samara. How are you?
I am good. I'm good. It's Friday and just came back from a week of travel across both coasts, New York, San Francisco, and now back Chicago. So, fall's busy, but it's good. There's a lot going on.
Oh, that's good. Well, it's and you're running a venture firm, an amazing venture firm. By the way, in full disclosure, everyone, I'm an LP in 2 of Samara's 3 funds. I guess the third one's still kind of in the works right now. A proud LP, I should say. A lot of and LP, limited partner. So I'm one of the hundreds of investors in Samara's funds. And a lot of times people throw acronyms out and you think everybody knows what the hell they mean. I had no idea, maybe 10 years ago what the heck an LP meant, and I know that now. But Samara,
wait, let me just say you are one of our biggest supporters. You're one of our biggest cheerleaders. You said yes early on for both funds, right? And so I just want to thank you for that, because I think you're first and foremost a friend of mine, a friend of the firm's, our biggest cheerleader, and a really great LP. So thank you for all your support.
Oh, well, thank you. No, that's great. Look, and I think, the funds are doing great, but I think for LPs, I think too, being limited partners, it's an interesting mix, right? I think I'm in 5-ish funds or something like that, and it's also a network, but it's also a way that you help these portfolio companies. Like, I have a vested interest to cheer you on and to cheer on your portfolio companies. I do it because we're friends and I join all that stuff, but I also have a vested interest to do that because I think it also helps them and helps them grow and helps your firm grow and the resources to help them grow, right?
Yeah, and we've co-invested together, both you as an angel and you through Angeles. So it's a great community also that you've built as well. And when people ask what's a great LP, it's obviously someone that gives you capital early on, someone that cheers you on, and someone that can co-invest with you if that's their thesis. So I love what you've built with Angeles and the community, and so I think there's so much more to build on that. But yeah, we're also great co-investors as well.
Great. Well, excellent. Well, Samara, a lot of our listeners out there may or may not know you, and you have an inside view to your story. And I'm sure there's probably things I don't know about the story, but share with our listeners your story, Samara.
Yeah. So my story started. I'm from Mexico. I came to the U.S. at a young age. I grew up in Chicago, and I was picked up math early on. I love math. I love numbers. And that's what led me to study engineering at the University of Michigan. So I'm an engineer by training. I love math and science, and I started my career on Wall Street. So I had a first internship there early on, and then I started full-time during the beginning of the last financial crisis, which was an interesting time to be on Wall Street. I given my engineering mindset and my technical skills, I had to switch to a sales mindset and a mindset around, and people think sales is kind of like a used car salesman or pitching and talking a lot. And it's really solving a problem for somebody. It's listening to your customers, understanding their needs, and positioning a product based on those needs. And especially during times when there's a financial crisis, when the world is blowing up, the market isn't performing, the products aren't performing, and your customers look to you for advice on what they should do. And so there's a lot of learnings around that, around building trust and relationship with your customers. And I still talk to some of those customers. We're still friends, and it was a good time to see, obviously, be on Wall Street, learn a lot about finance, but then also learn beyond that very quickly on trust that you build with your customers. And so I was there in the beginning part of my career, and then I went to business school here in Chicago, and that's where I got exposed to venture capital and early stage investing. I fell in love. I was in an internship with an early stage group here, and I fell in love with it. I was like, what is this? You have no numbers, no revenue, barely a product, an idea, and a team, and you have to figure out how to invest. And you get to be a tiny, tiny piece of that in a founder's life. And you also, they're building products that maybe there may or may not be a market for it. They're building a product that sometimes hasn't been even developed before, and you have to figure out if this is a winning product, a winning team, the right market. So I fell in love with it, and I found two founders here in Chicago that had just started their firm. I joined them as a third person on the team. I helped build the firm from the ground up, did everything from sourcing to creating new ways of doing due diligence to working with our CFO through audits. And so that was a great groundwork for me to learn what it is to build a firm from the ground up. And then I was fortunate, I was there for 5 years across two funds, and I was fortunate to be able to then start my own venture firm, not ever thinking that I would when I got into venture, but I saw an opportunity to go in earlier, especially in ecosystems that didn't have mature angel networks, so Chicago being one of them, but many outside of the Valley, to go in industries that were growing, but VC was slow to fund, and three, go with founders that didn't fit the traditional mold in terms of founder background, experience, and geography. So we founded Chingona Ventures in April of 2019. We made 27 investments across fintech, future of work, future of learning, and health tech. And then we launched Chingona Ventures Fund 2 in May of 2022. And that was a $53 million fund. We've now made 27 investments. We're about to do 28 investments in the fund, and we're at the end. And then, so yeah, we're coming on Fund 3. So it's been a journey, and there's been so much in the last 10 years that I've been in venture capital. And they always say the longer you're in venture capital, the more humble you get. And that's true now more than ever. And I know you've been in this space for a while. So it's been a fun time to be in it. And I'm just fortunate to do what I do every single day.
So when did you first hear about, so you're in Wall Street, you get an engineering degree from Michigan, great school, phenomenal school, by, Chicago, Michigan, getting, great school. And then you get, to Wall Street. How was your familiarity with venture when you were on Wall Street on a scale of 1 to 10? Zero. Yeah.
Zero. I mean,
it's like, yeah.
We started to sell some private equity products, and we talked about the J curve and all that, but it was very little. I mean, there was certainly not any venture capital. These were alternative products that you put, less than 10% of your portfolio. They're high risk, high return. So we were talking more about core equity and fixed income products, some non-correlated asset classes, very little alternatives. So not a lot.
Interesting. Yeah, no. It's basically kind of would it be fair to say when you got your MBA is when it was kind of like, oh, this is interesting. You're getting is that where you started hearing more about it, or when did you get more?
But so I graduated, and when I graduated, I didn't know anybody interviewing for venture capital. I don't know if anybody in my class got a job in VC right after business school. People that were going into finance were going into private equity. They were going to investment banking. They were going to maybe some hedge funds. But Chicago was still growing. It was still small. I mean, Chicago has grown a ton. in venture capital, but there was very few funds at the time, and jobs weren't posted, right? It was, I mean, more jobs are posted now, but very few jobs. You had to find somebody that knew somebody in venture capital. And so I was so naive because I just thought, great, this is a great place to go into. I'm going to go find a job. And I actually went to 1871 here in Chicago, which was this startup ecosystem. And Northwestern had a room there that you could go as a student. And so I would go there and I would literally, this is where my sales skills came in because I'm a natural introvert. I'm really shy. Growing up, like I don't do this, but I would go up to different startups and ask them if they needed help with anything, if they needed help with putting a pitch deck together or doing a financial model or doing customer discovery calls. I helped one put together a deck for their Series A raise, but it was what I could find. And then I remember a VC here. Uh, he saw me working on this, me and my friend, and he's like, what are you guys doing? He just like approached us because we were like hustling and trying to figure it out. And we were telling him what we were doing. He was like, well, I have a project for you. So that was my first project with a venture firm out here. And I put something together I think it was for a potential LP because they were trying to pitch a corporate on how to be a part of their innovation team and what that could look like if they made an investment. But yeah, no, it was a grind, and I didn't know how hard it was to get into venture capital. I didn't know the percentages of people going into venture capital, the backgrounds that you needed. So a lot were former operators of unicorns. They were typical Silicon Valley, Stanford, like, and I didn't have any of that. I didn't have the network of knowing somebody. Some venture firms start with some family money, and they know a lot of high net worth individuals and family offices. I didn't know that wasn't anybody in my
Your
network.
family wasn't able to help,
And
bootstrap you with,
no,
5-20 million or so?
no, yeah. I mean, and some people literally have their families put in $1 million check and then, they start making investments. So no, that's very few of us, right? And so I think it was good. Early on in my career, I would say it was good to be naive because even engineering. So I did not know how hard it was to get into Michigan engineering. I didn't know it was the #2 program in the country at the time for what I went to, but I loved the football stadium. And so I just applied and I got in. So I was like, great, I can go see some great football games.
Big house, the big house.
Right. Oh yeah, exactly. Yeah. And so I didn't know how hard it was to get into Goldman Sachs. I remember I was at an engineering conference and they were there, and I went up to the person because a friend of mine was nearby, and I just said, "What do you guys do?" I had no idea, and there's a whole line. I just was like, just curious, and then they're like, "Well, you should apply." I was like, "Okay," I had no idea. And then my business school friends were like, "Oh my gosh, you got an interview with Goldman Sachs," that's like the Gucci of investment banking, and I just had no idea. And so I think early on in my career, I just did things that I thought were interesting. I was just really curious, not knowing how hard it was to get in, and I think that benefited me because that's why I went for it, because I didn't know that it was nearly impossible. I'm more intentional later on in my career, obviously, but yeah, I think, and that's what I tell a lot of younger people. It's just um, just explore and be curious and go for things, and even roles that you don't think you qualify for. I think early on I would always look to see if I had 10 out of the 10 things, and my boyfriend at the time, not my husband, was like, no, you can learn the rest of the 5 things, just apply for it, you have the potential to learn. And so even now when I hire, I look for things. When I put the job application out, I always say, even if you don't have all these things, still apply. And I always look for potential. So what does somebody have, and what are the things that they can learn? And I realized, so interesting, I have an analyst on my team that came from the same sales desk because I did it at Goldman. And most people, hire very technical people, product people, and she had started a small business in high school, and she had done some entrepreneurial things, but she had this sales skill, and I hired her, and she is just aggressive with sourcing. She is hungry for deals. She will reach out to people that were like early PM at Bumble, like early whatever, and they'll respond to her, right? And so that's one of the skills that you don't necessarily think, but is so important in sales, right? As in VC, to get founders to take your calls, to get them to, obviously to get investment from you, to pitch to LPs like yourself,
Pitch to LPs.
to
That's what I'm saying. Fundraise. Oh my God.
oh, you know it. You experience
Tell me
it.
about
It's
it.
a whole thing, especially when you don't have a track record or when you're new to a fund with a new, GP. It's like you're starting all over again. And so you have to pitch on an idea and the belief that you're going to be successful at this. So yeah, I'm a big fan of these non-traditional people, non-traditional hires, non-traditional founders to see potential, to see opportunity. Because the obvious ones are everybody's going after. The obvious ones are like, okay, this is what's worked in the past. What I love to see is finding these unique opportunities that are not obvious yet and taking a bet. And obviously that there is a risk to that, but that's where the fun part comes. That's where the alpha comes in. So yes, I do that in all aspects of my life.
Cool. Really cool. So this exponential growth podcast, we like to educate the audience on trends, exponential trends that are out there, many infused by technology, but not necessarily. You have an interesting viewpoint into trends that are going out there, technical and not, but you have the engineering math background that gives you a little bit more view in there. You have, I think you mentioned almost 50 or so across your funds, startups you've invested, probably another hundreds, if not thousands that you've seen. What can you share with our audience from your viewpoint? What are the top 2 or 3 trends that they should be aware of, dig into, understand deeply?
So I think so. Let me take a step back and speak to early stage startups, particularly in venture capital, because that's my world. The traditional way of doing venture capital has completely flipped on its head. So what I learned 10 years ago when I got into this has completely changed from everything from what a venture firm is to what a growth in a startup means, to what is going to have what businesses you avoid and what businesses you focus on. And let me dive in a little bit deeper. So the first thing is what a venture capital firm means, what it means to be a venture capital firm. This has completely changed. So now venture firms are becoming asset management firms. The biggest players are taking a lot of the money from the LPs, and they are not only investing in high growth startups, they're starting to have a PE-like model. They're trying to become an RIA, a registered investment advisor, right? It's just becoming a very different thing. And what's driving that is one, money in the ecosystem, but two is what exits have looked like, right? Exits have changed. You used to buy and hold and wait to IPO, and that model has changed. It's taking longer to go public. It's companies that are being successful don't necessarily want to go public because there's all the reporting requirements, all the rules required with that. They want to stay longer, public, private longer. And so you're trying to figure out how are you going to get returns in a very different way. And is it becoming a PE-like shop? Is it selling to the secondary market in a different way? Is it building a big enough firm where you support them from idea to exit? I mean, there's so many different models. People are investing in sports teams now that are venture capital firms, right? And so it's just become very different. And so a lot of emerging managers, a lot of fund managers are trying to figure out where do I place myself? Where is it in this new ecosystem that's evolving that I need to place myself? So that's one piece of it. The second piece is the type of businesses that you have historically invested in. So there's this really interesting thing, and I love that's why I have 2 younger investment professionals that people are like, oh, they're younger, like you need someone senior, and they are looking at things from fresh eyes, which I love, right? They're looking at new trends, they're experiencing it, they're at the forefront of it. And they're also like, well, why aren't we investing in this type of business? And then in my head, I'm like, well, we never have. They have low exit multiples, right? But these new technology tools have completely changed the game, particularly AI, right? So for instance, one example is traditional services businesses. Traditional services businesses are those that have great cash flow early on. They're tech enabled in some cases, but they're like basically putting up a website and then that's their tech. But really, it used to be lower margin businesses. They used to get acquired for 1 to 2x revenue multiple. And those weren't necessarily considered high growth or big venture outcomes. AI has completely flipped it on its head. And there was one article, I forgot what it's called, but they talked about the revenge of the services businesses, where now they can get SaaS-like margins or much higher margins because they're able to be more capital efficient because they're able to use AI tools. And all of a sudden, they can get venture-like outcomes, or they can get rapid exponential growth. They can be very capital efficient, and they don't necessarily need to raise a lot of venture money because they have these businesses, their services businesses, they can ramp up to certainly from 0 to 1 million very quickly. And now you have to look at them in a very different way. And we have looked at some of these businesses and I'm like, whoa, this is completely changing the game. But I attribute that to my younger team of looking at us from a fresh perspective, right? And assessing those deals. So that's the second piece of it. And then the third piece of it is just the way you think about growing a business is very different. So going from 0 to 10 million in revenue took years. And now people are doing that in months.
Yeah.
Right. And in some it's real and not I don't want to say real, but some, you don't see the 1 to 2 years that they were building on the back end. And, they talk about 0 to 10 in a few months, but still, I mean, it's rapid. And there's not one board meeting I'm not a part of where they're talking about how do we become more productive? How do we test this out without hiring somebody? And you can do that with AI. There's limitations. There's certainly limitations of what AI can do, and we're experiencing it firsthand as we implement it into our organization. But it how quickly these models are learning, right? Right now, maybe they're 30 to 40% accurate or whatever it is, and you have to type in, follow-on questions to get the right answer. But I heard this stat from a GP building a AI first company. She believes this is Lan from Basin said. I was listening to her recently at an event, and she was saying that within less than a year they're going to be at 70 to 80% accurate, right? Which is a crazy number, but they're getting faster and more accurate so much quicker, and there's so many tools being developed so quickly to help businesses become more efficient. Many of we've invested in that. It's just changing the game as to how much you raise, what you can do with what you raise. Do you really need to hire people to do this? Can you become more efficient? Even just testing things out. And so, for instance, one of our companies in our portfolio is called Optimal.ai. They are helping review people's code and helping them make sure it's compliant, see if there's any errors. And they're doing it better than some of the bigger tools out there right now. And one of their customer feedback was like, basically, you're able to hire a software engineer for $20 a month, right? Is how they're viewing these software businesses. So that for us is like, okay, how do we think about how much capital they're going to need to raise? How do we think about, maybe they only need to raise 3 million and they get to 15 million revenue. Who knows, right?
Which is, better for all,
which is crazy,
right?
better for all of us, right? Now, granted, there's a lot of competition in the market, and then raising is better for them to raise so they can go faster than raise so they can figure out product market fit. So for that, that's changing the game on its head, which we're excited about, and so those I would say are kind of the big three things that we're seeing in terms of changes, certainly within the last year or two, that have been very different and very rapid in the last 10 years in venture capital.
Yeah, there's a couple of ones I wanted to just pull out there. The time to start and scale. You think about, I was in Bogota, Colombia at their tech week, and I was talking on some panel, and I was just like, if you look at Ford Motor Company, it took them 40, 50 years to get like to $1 billion in value. Google's 15, 20 years, right? But the time, whether it's to create revenue or get to $1 billion in value, just keeps getting smaller and smaller and smaller. And it always will, right? It's just going to always get to where, where does it kind of hit infinity or whatever? It's like an idea, capital, resources, product, all coming together at once, right? And hitting the market and growing and scaling.
Yes.
And
yes.
so that's where, that's with all these tools, one way we're going. And then to your point, it was like also team size. I mean, you think about Ford, where to get to $1 billion in values, I don't know what, 100,000 employees, 200,000 employees, now you're doing it with, one, two, three, four. You're going to be able to do these with, human, 1, 2 to 3 humans. And so how, as an investor, and these are the things that all the changes and the modeling and the things that we have to do of these trends that should continue to happen and continue that will happen.
Oh, totally. And with that, there was one of our portfolio companies called Agency, Elias Torres, who is one of the very few Latino unicorns. His last company, he started Drift, was one of the got acquired for over $1 billion. And he's a friend, LP in the fund, and also a portfolio company. And he says a lot on LinkedIn. But one of the things he had mentioned was that it used to be a thing you brag about how many employees you hired, how much you raised. And now it's completely opposite. It's like, how much did you raise versus how much revenue you have, and how few employees you've been able to build a product with. And he goes, I never want to have a company that's bigger than 100 employees, and I don't think I need to. And so it's really interesting. That's another thing, is like, now you're looking at revenue per employee, how much employees you have versus how much revenue the company has. So there's a lot of really crazy and interesting things. And one thing I'll say with that is that we're all everything's changing so rapidly, and we're all going so fast. But there's some things that we're starting to find holes in. And I think we're going to start experiencing that more. Like, I think we're still in the early stages. I mean, no one knows where we're at, but we're definitely still in the early stages of figuring out what is a good AI company, what is true AI, what are people actually going to buy? Because we're in the stage right now where, there's some companies getting some early traction. Why? Because a lot of enterprises have these bigger budgets to spend on these AI tools. So everyone's trying different things. And so one year you can get a pilot, and the next year you don't know if it's going to convert to a contract or not. There might be a brand new company that's doing it better than you. Or they've decided that, they're trying 10 different things and you're just going to focus on 2 things. So that is not guaranteed of, recurring revenue.
Right.
And to the recurring revenue piece, right? Like SaaS margins used to be at 80-90%, and now they might be closer to 40% because of the AI costs associated with it. So that also, we're taking a look at. And again, like, the way we used to look at businesses for 10 years it's just changed so much in the last 2 years. And so we're constantly assessing that. The other thing is, even internally, we've made it a point to supercharge our operations with AI. Made it a point to reduce the how long it takes to do all the tasks. We literally have all the tasks written down, how long it takes, and reduce that by 50%. And as we're doing it, we're trying all these different things as tools, and we're slowing down. Well, me as like the old person on the team, is like, I feel like I'm just so like, wait a minute, let's slow down on testing ChatGPT. But doing it with creating an AI policy, creating AI guidelines, making sure your cybersecurity is in place. I'm actually looking at a lot of cybersecurity companies right now. We just did an investment 2 weeks ago in it. And the amount of things that CISOs are trying to understand that's happening so quickly. Every employee is using AI, whether it's, it's allowed or not allowed, or they don't know. They're testing it out in every single industry. And so how do you, as a CISO of a company, make sure that that's done in a compliant way, that data that's not supposed to be shared is shared? And even if you have the enterprise version and it says, we're not going to share this with OpenAI, how do you guarantee that it's not actually being shared? So there's all these security issues around that you have no idea. And so, so with all this, crazy movement, go fast, I'm also looking at companies and that are also figuring out, like, okay, what holes does this poke in an organization? What going so fast? What's going to be wrong with this? And how do we ensure that it's done in a way that's secure, that where our data isn't being shared? And so that's another opportunity in the market that we're seeing.
Yeah, the funny thing is, like, I remember I don't know, you give your email, your phone number out to somebody, they're like, no, yeah, no, it's guaranteed. We got it all secure. And like every time you open the newspaper and like, oh no, this one, they've been breached. So I don't like it. I don't buy that. And then to your point on all the change that's happening, right? This is kind of why I believe in this exponential growth podcast, because how do there's so much happening so fast. How do you keep up? And I think the one way you keep up is you listen to great leaders who are kind of in it, and you're getting different perspectives from this vantage point. I have somebody to talk about energy and all the stuff that's going on with energy, right? And just all these different areas, and it's an amazing way to do it. And by the way, too, I'm learning a lot too, right? So it is also
Yeah.
good for me as well. So Samara,
Well, also,
go ahead.
just one other thing with that is I was just on a panel with Brad Feld yesterday. So I'm a part of Venture Forward.
Yeah.
It's part of NVCA. We're doing a lot in the venture capital community on mentoring young venture capitalists, on mentoring emerging managers. So they're doing a lot. And Brad Feld was one of the early donors to this organization. And we were doing a 5-year anniversary event. I was moderating a panel with him, and I asked him about AI because obviously no panel, is a panel
Not a
without
panel if you
AI,
don't ask
right?
about AI. Yeah.
Exactly. And so I asked him about it because he started his career in the 80s, and now he's trying to figure out, like, what does he think about AI, right? This is, and he talked about the early 2000s, about how software was there and people were worried about it, and thought it was like a trend, and just whatever. And so he's gone through a few different cycles of this. But one of the things he said was, around any new tool is trying it and is playing around with it and doing it. It's so everybody, I think there's a lot of people using it, but certainly not every single person. And we look at businesses that are selling into small businesses, like small law firms and small car washes, and right, that are like, how do I even do this? How do I even try? What is this? And so he said it's just playing around with it and testing it out. Obviously, for me as a business owner, is how do we do it in a compliant way? How do we make sure we're going fast, but we're slowing down to make sure that we're seeing where all the data is going, and we're making sure that it's right. Because right now, you put something in ChatGPT, like an investment memo or a one pager, and you read it, it's like some of it doesn't make any sense whatsoever, and you're like, where did this information come in? And he even said he said he loves pushing back on ChatGPT and saying, like, actually, I think you're wrong. And then
No, I know. I've done that too. How do you
right?
get this data? This doesn't make sense.
Exactly.
And then the AI will be like, oh yeah, I'm sorry, you're right. It's like with a little bit of a personality too, which is kind of
They're
crazy.
not trained. They're not trained to push back, on you, and they don't know that you're playing around and question them on purpose. But there's a lot of limitations to it, and so being able to make sure you get something and not assume that it's correct, and checking to see where do the sources come from, checking the links. And so that's where it is right now. It's going to be very different in a year. But anyways, I wanted to mention that because he said one of the things to do is start testing it out, start trying it, start seeing what are the limitations of it, start questioning where the data comes from, and be able to obviously incorporate it, but start using it, even in a small way. So I think that's really important, because a lot of businesses are also like, we're going to be left behind if we don't use it, and everybody's trying it out, and we'll see where we get to in the next few years. But it's just completely changed the game on what you're able to do from a productivity perspective at work.
Oh yeah, and more to come, and more to come.
Yeah.
So that kind of helps us segue, Samara, into so there's these trends, and maybe your investment, right? You invest in a high risk, high return asset class. There's many asset class, right? Real estate, stocks, bonds, cash.
Mm-hmm.
Bonds, cash, pretty boring stuff. But so, to our listeners out there, just with the context of the trends that are going, that you as a venture capitalist, how do you, or give them some thoughts, tips, maybe not tips, you get in trouble with the tips, but just perspectives on investing and things that they should think about as they build their portfolios, as they invest, based on all the experience you have.
Yeah, and it's particularly if it's an individual. If it's an individual, it's great, because you can invest in whatever you want to invest. And I say that because as a fund manager, I am investing based on a thesis that I pitch to my investors. And I can't really go outside of that thesis, right? I mean, yes, they're paying me to see the early risks or trends in the market and make adjustments, but I can't go from being a fintech fund to a crypto fund, right? Or pure crypto fund, or going from a climate fund to only investing in healthcare technology. But as an angel investor, you can do whatever you want. And the first thing I would do is just to start, because so many people who don't understand it, who think it's a high risk asset class. You can do that in so many different ways. You can do it through angel groups. You can do it through platforms where you can invest even $100, right? And so there's so many different ways you can do it now, and understanding that it's a high risk. And it's not like you're gambling, but be 100% okay with losing the money that you invest, because it is high risk. But I would say start with things that you, first of all, understand and are really curious about and are really excited about, because you will just naturally be drawn to it. You will just naturally ask a lot of questions. The way I think about as a venture investor in a very high risk asset class is fully understanding what are my risks today and how do I mitigate those risks. Now, you're not going to be able to 100% get rid of all the risks, but understanding what those are, and are you comfortable with those? Or can you mitigate it by helping the company? Or can you mitigate it by saying, all right, this is the risk, but we have belief in the team to be able to pivot? Because at the stage I invest in, it is so early. Everything they present to me, I know it's going to change in 12 months. They send me their financial models. Like, I know that this is going to be wrong. This is wrong. That's the one thing I know for sure. But it helps me
This
understand.
is a beautiful financial model. Let me tell you, the one thing I know for sure, this thing's going to be wrong.
Exactly. Right. Of course it's going to be wrong. However, it helps me understand how you're thinking about the business. It helps me understand how you're thinking about, how you're going to get to your milestones in detail, how many customers it takes, what contract value you're thinking about for your customers, how that's going to expand, all the different things. And so I have a full framework. I do full due diligence, and people are like, what do you do due diligence on? It's pre-seed, right? We have a whole framework that we use on experts that we speak to, on customers, potential customers. We've done reference calls on former college coaches even, right? Like we try to understand the full spectrum of the person first and foremost, because a lot of times early on, it is the team that you're investing in.
Oh yeah.
But also, and I always tell my team, when they first start, there's so many ways you can say no to a company. It's figuring out what is the yes, what is the excitement and opportunity. And for me, the less you have, the more it's about the team and the opportunity. But the more, actually, this is counterintuitive, but the more detail I'd like to see. Because it's helping me understand that you have a plan in place, that you have a roadmap, knowing that it's going to change, but it's how they can communicate this. And the best ones are the ones where you come out of the meeting, you're like, whoa, like you learned something brand new about a space that you had never thought before. Even if you've done a ton of investments in, call it fintech. I've done a lot of investments in fintech, and they have just this view of the world that is crazy, but they have early traction, that they're early in on this trend and this change. And so for me, the advice I would give early on is just like, okay, if you're an angel investor, be an individual, you can first of all do it yourself, or you can do it through platforms like Angeles or through other angel groups that have people that have done this for a while. They have co-investors like Chingona that do a lot of the due diligence, that can come in and educate people on the market and understand obviously the risks, but go into a space that you're really excited about. Because talking to these founders is so exciting, right?
It is. No, it is totally
right. They have this whole viewpoint of the world that is so different. They're the first to market. They're getting early insights, and there's, for us, we're very values aligned, but we invest in a lot of companies that also are thinking about changing the world in a very different way, that there's these huge problems that need to be solved. And these corporations aren't going to move fast enough. And it's these individuals that have this unique mindset, this unique perspective, that have the risk tolerance, have the capital to go off and attack it and solve these problems in a way that it's never been done before. And then you as an investor get to be a small part in that. And that's really exciting.
Yeah, and it's also such a privilege because you're getting to see a lot of startups who are really solving big problems. They're coming with the passion and the innovation across a lot of different things, and you're like, this is amazing. So you think about the repetitions that we get, and it kind of starts to also shape your view on what the future is, right? Because these startups are trying to break in and grow and scale something that's going to be very big in the next whatever 5-10 years. In order to do that, they got to use tech. They got to come forward. They got to come with speed, and it is such a privilege. To I mean, you
And
see all those too, and then you're investing. You get to in a select few, right? Because I think what you look at 1,000 deals or so, and for every 1,000 deals that you hit in your funnel, Samara, how many are you investing in ish?
less than 1%. So we look
Yeah,
at over 1,000 deals a year that just go through in our system, way more than that come to us.
yeah,
But yeah, we're investing in about 10 per year, maybe plus or
yeah,
minus. So it's a lot. And that's another thing, is that these founders are getting told no constantly every single day. And they have to believe enough. They have to have both confidence and humility. Confidence in, when a lot of people are telling them no and that it's not going to work, that they will do it. But then also humility, where it's like, well, if there's a point where, okay, this is actually not going to work, right?
yeah.
And so we have to pivot to something else.
There's
So
been
you got to have both
too
of
many, a
those.
little bit too many no's. Maybe it's something. Maybe we got to shift a little
There might
bit.
be something there with maybe your story, or right, but the best thing is that if founders, and you hear all these stories that are like, oh, the founder raised 50 million, 100 million on a deck and an idea, but you don't realize that they have a network, they have built businesses before, they're an expert in this space, right? So you don't hear that. But if you're a founder, doesn't have a network, who's never built a company before, um, raising money is going to be even harder. And how you do it is you actually have to have more proof points, because you're not going to, unless you know people, you're not going to raise off on a deck an idea, and if you didn't go to Ivy League and have the network. So a lot of those founders are ones where they get early traction. They have very little resources, very little capital, but they built something and they start testing it out on nights and weekends. They have early users, they have an MVP, they have pilots. And so then it's like, do you raise venture money? Because venture capital money is very different. All of a sudden, you have investors you have to answer to. You may have a board. You have to grow very differently. I've invested in a company with a founder that started a company before, but it wasn't venture backed. And then when I invested, he got really excited because he wanted to be acquired for 100 million. I was like, oh no, we got to go much bigger and much faster. It's a very different ball game, because our expected returns are very different, because you as an LP can invest in the stock market, right?
Yeah.
And get a different level of return with a lot lower risk. So we have to grow very quickly because it's a risk return profile. It's a lot of risk, but that means that the return has to be ginormous. So yeah, so there's a lot to these founders that get told no all the time, and having that right balance, and taking venture capital money is a whole different ball game.
Yeah, and it's so it's like you got this all these different assets you can invest in, right? We spend a lot
Right.
of time here talking about the venture and the angel space and the startup space, high risk, high risk, high return. But I think some of those too, also the learnings and as you construct portfolios, right? You have some equities and stuff. A lot of these lessons, apply across, right? I mean, even if you're investing in a public stock, right? You're looking at risk, you're looking at the future, you're looking at the trends, liquidity, to your point, and thinking about it that way too, right? I mean, how, with this asset class, that this, call it venture angel, right? The liquidity, I don't know, roughly 8-10 years ish,
Mm-hmm.
which to your point, you got to be investing in companies that are well beyond 100 million, a billion, they have paths to get there. So you can get these investors returns, because why would I invest in getting 20% when I can invest in, I don't know,
Yeah.
stocks or whatever,
Anything else.
Microsoft, Google, Oracle that just went up 60% in a day. I don't know what, 30-40% in a
Yeah.
day. Right. So
That's another thing. Yeah, that's another thing with early stage investors is understanding the risk, understanding that you are going to invest in this company. It's going to be a long time cycle, right? It's not going to be 1-2 years. It's going to be sometimes 10 years, 15 years. And that's one thing that actually has started to change in the ecosystem. So one of my LPs, who is a founder or GP, one of my limited partners, that's a general partner of a fund in the early 2000s. He's one of the best performing funds. And I asked him, "What's the playbook, right? Or how did you make your first unicorn? How did you make your first fund?" And he said it was in year, what was it? A year 14 or 15 of his fund. And fund cycles are
whatever.
year 10. Yeah, his fund one. And it was that company was in the bottom 5 of his portfolio. I think he had like 20 companies for the first 10 years. And he didn't return the fund plus more until year 15. And that's how long it took to get your money back, but a lot of money back. Now, I will say that that's changed from LP's perspective. A lot of investors want their money back sooner, and their GPs, investors, have been trying to build creative ways to get the money back sooner. And I don't know what sort of impact that's going to have, because there's 2 trains of thought. So one train of thought from investors, general partners, is, okay, if the companies in my portfolio that I want to sell, the companies in my portfolio that I want to sell aren't doing well. The companies that I don't want to sell, everybody wants to buy, right? And so the companies that are not doing well, nobody wants to buy. The companies and they want to buy at a discount. The companies that are doing well, I don't want to sell. And there's this buy and hold mentality. And still, that GP that I mentioned that was very successful, he still talks about that. He's like, if I have a high performing company, I am going to buy and hold till to extract the most amount of value, IPO plus. And there's some of my friends that say, no, I'm going to exit the company at Series B. I'm going to exit the company when they get valued at 300 million. I'm going to exit part of it. And a lot of LPs are demanding that right now. And so there's this whole conversation in the ecosystem of what is the right exit price, what's the right exit time, and LPs have very different perspectives. I actually was doing on a call with an LP, and they asked me how I thought about because I'm in year 4 or 5 of the fund, and how I'm thinking about exit. And I'm like, wow, there's literally some companies I just invested in the last 12 months at a pre-seed, meaning that like they just launched their product. And they're asking me this question, and it wasn't unique to them. They had 2 or 3 other LPs ask me this. I was like, this is really interesting. Like, if I respond to, I'm like, are they trying to trick me? Like, if I respond and say like, no, I'm going to sell my position now, is that a bad thing? Is that a good thing? Right. And I have my own framework on what that, and I answer the question based on what we believe is right. And the returns. Now we have a certain philosophy around that right now. But yeah, no, it's back to the earlier point we had, like the venture capital ecosystem has changed so much, and everyone's trying to kind of figure out, and everyone has their own debates on what that should look like.
Well, Samara, it's been great. I know you got a lot of things going on, very busy. We're honored that you were able to take the time with us and share your perspectives on exponential growth across, some of the trends, investments, your leadership thoughts, growing your team, driving operational efficiency. How do our listeners out there stay connected with you across social media platforms?
Yeah, absolutely. So first of all, any business that has an opportunity for us to invest in, go to www.chingona.ventures. www.chingona.ventures and go to the submit button. We literally look at every single deal that comes to the door. It'll give you a description of exactly what we invest in. And I actually have invested in companies that came from Cold Inbound, 2 in the last year. One of them was a founder that heard me on Bloomberg, and I said the same thing. They applied, and then within a year, we invested in an oversubscribed round. So it does work. So please submit your business there. And we're on LinkedIn, Chingona Ventures there. We're on other social media platforms, but reach out, follow us. We have our newsletter that just came out. You can see what we're doing in our portfolio, events that we're at. So you can connect with us. So we'd love to hear from you. And David, thank you so much for all that you do for the ecosystem. And if you follow us on LinkedIn, you'll see David always like our posts and comment because he's our biggest cheerleader.
Proud cheerleader, proud chingon.
Proud Chingon.
helping Chingona Ventures out. No, Samara, again, thank you so much for those out there. Follow them, stay tuned. I mean, they're just warming up. A lot of great things are going to be coming from Chingona Ventures. So stay tuned to Samara and her amazing team at Chingona Ventures. Thank you, Samara. Have an excellent weekend.
Thank you. You too.
All right.